Did you buy near the top, then sell near the bottom? Most careful people have, at least once, and then carried it quietly for years. You weren't careless. Careless people don't sit up past midnight with a thumb hovering over a sell button, arguing with themselves. That hesitation is the tell. What moved you in the end was something older and steadier than judgment, and it lives in all of us. Over the next quarter of an hour, we'll trace the cycle that turns thoughtful savers into badly timed ones, where it starts, how it feels from the inside, and why it so reliably ends with the wrong move at the worst moment. We'll name the single piece of wiring underneath it. We'll look honestly at the times patience genuinely fails, because pretending it never does would insult you. And we'll finish with a few quiet habits that lift the hardest decisions out of fear's hands altogether. You won't leave with a stock tip. You'll leave understanding why a downturn feels the way it does, and a good deal calmer about what to do when the next one comes. Chapter 1. The Feeling That Buys at the Top. Here is the strange machinery at the center of all of this. In most of life, your feelings are a decent guide. Something feels dangerous, you step back. Something feels safe, you lean in. That instinct kept your ancestors alive on open ground, watching for movement in the grass.
In markets, it runs exactly backwards, and it does so quietly, wearing the face of good sense, which is what makes it so hard to catch in yourself. Let me show you with a saver I'll call Maya. She isn't a real person, just a familiar shape. For most of a year, Maya keeps hearing about other people's gains. At a dinner, a friend mentions almost offhand what their account has done this year, and there's a small ache in her chest. The feeling of arriving late to something everyone else already understood. She isn't envious exactly, she's just tired of feeling late. The market keeps climbing, the commentary grows sunnier by the week, everyone sounds certain, and certainty is contagious. By now it feels obviously safe. The risk, if anything, seems to be missing out. And so, near a high, she finally moves a large piece of her savings in. For a few weeks, she feels the quiet relief of having caught up. Then prices slide. Slowly at first, a soft leak nobody quite believes. Then all at once. Her relief curls into unease, unease into worry, worry into something close to dread. The same commentators who sounded so sure reach now for their darkest words, and the numbers on her screen seem to confirm them. She stops opening the app at breakfast because it ruins the morning.
And one evening, when the pain of watching has finally grown heavier than she can hold, Maya sells, near the bottom. The sick feeling lifts almost instantly, which feels in the moment like proof she did the right thing. Within a couple of years, the market has climbed back past where she bought in. She was not there for it. Notice she did nothing stupid at any single step. She felt safest at the top and most frightened at the bottom, and she acted on both feelings faithfully, the way a sensible person acts on what their gut is telling them. That's the trap. The emotions arrive in a dependable order: hope, then confidence, then a kind of thrill, then anxiety, then fear, then despair, and each one feels like clear-eyed judgment while you're standing inside it. Comfort in her gut lined up neatly with the most expensive prices. Terror lined up with the cheapest. Her feelings were doing their honest job. They had simply been pointed the wrong way, and most confidently at the worst possible moments. So the real question isn't why Maya was weak. She wasn't. The question is what underneath all of it makes a falling market shout so much louder than a rising one ever did. Chapter 2. Why Losses Shout and Gains Whisper. The answer has a name, and it's the closest thing to a root cause we have.
In 1979, two psychologists, Daniel Kahneman and Amos Tversky, set it down in what became known as prospect theory. We do not feel gains and losses on the same scale. Losing hurts markedly more than an equal gain pleases. It's standard human equipment, as common as depth perception. You can feel it yourself with a coin. Suppose I offer you a single flip. Heads, you win $100. Tails, you lose $100. A fair bet, even money, no house edge. Most people say no. The possible loss simply weighs too much. The imagined sting of handing over $100 outmuscles the imagined pleasure of receiving it. And if you ask how large the winning side has to grow before the flip finally feels worth taking, The honest answer, for most of us, lands somewhere near $200. The gain has to roughly double the loss just to make the wager feel even inside our own chests. Losses loom about twice as large as gains. Twice. That's not a quirk you can lecture yourself out of. You can know it cold and still feel it at full strength. I do. It's the engine under the whole emotional cycle. A rising portfolio produces a mild, pleasant hum you can ignore for months at a stretch. A falling one produces a pressure, a physical, insistent pressure to make it stop that a rising market never once generates.
And that lopsided pressure is precisely the hand that reaches for the sell button. The market isn't asking you to sell, your own arithmetic of pain is. You can watch it cost real money, in aggregate, across millions of people. There's a pattern researchers call the behavior gap, and the firm Morningstar measures it every year in a study plainly titled Mind the Gap. What they find is that the average fund investor earns noticeably less than the very funds they own, on the order of 1.5 to 2 percentage points a year over the past decade. The funds did fine. The people holding them trailed the thing they held. The cause was timing. Money flowed in after the good stretches and out after the bad ones, and each round trip quietly clipped the return. Let me turn that abstract 1.5 into something you can hold. Picture $100,000 left to compound for 20 years. At a steady 8%, it grows to roughly $460,000. Now shave off just a 1.5, call it 6.5% instead, and that same $100,000 grows to only about $350,000, about $115,000 gone. And not $1 of it was lost to a bad fund, a bad economy, or bad luck.
You paid it purely in timing, a tax on your own nerves, collected a little at a time, on the days you couldn't bear to hold. That gap is loss aversion, wearing a price tag. So when the urge to sell rises up in you, thick and certain, you can learn to answer it differently. Instead of hearing it as the market telling you something, name it for what it is. Loss aversion, roughly doubling the pain, doing exactly what it does. It's a feeling to be felt and waited out, not an instruction to obey. But naming the feeling only helps if giving into it is genuinely expensive. Is it? What does stepping out to feel safe actually cost a patient person over a lifetime? Chapter 3. The best days keep bad company. More than you'd guess, and for a reason almost nobody sees coming. The firm J.P. Morgan lays it out in its guide to retirement, and I'll offer it the way it should be heard, as a lesson drawn from the past, never a promise about the future. Picture $10,000 placed in a broad basket of American stocks and simply left alone for the 20 years from the start of 2003 through the end of 2022. That stretch was not calm. It held the financial crisis of 2008, when it truly felt as though the system might not hold. It held the crash of early 2020, when the world shut its doors in a matter of weeks.
Stay fully invested through all of it, every scare, every dark headline. And that $10,000 grows to roughly $64,800, about 9.8% a year. Now imagine you did almost everything right, but you stepped out during the frightening stretches, sold to feel safe, waited for clarity, and in doing so you happened to miss only the 10 best single days across those 20 years. Just 10 days out of roughly 5,000 trading days. That same $10,000 grows to about $29,700 instead, roughly 5.5% a year. Less than half the final sum, surrendered over 10 days you weren't in the room. The difference is about $35,000, more than 3 times the entire amount you started with. And you didn't lose it by adding less money. You added nothing either way. You lost it by being absent for 10 days out of 5,000. Here is the part that makes staying seated so hard and so necessary. Those best days do not wait politely for the weather to clear. 7 of the 10 best days in that whole span fell within just 15 days of the 10 worst days. The rebound tends to arrive while the fear is still thick in the room, sometimes the very next morning, after a night when selling felt like the only sane thing left to do.
The market often does its most important work on the days that feel least survivable, which means the person who sells to escape the worst days is standing, almost by definition, in exactly the wrong place to catch the best ones. It's a little like slipping out of a long, tense dinner the moment it curdles, coats on, quiet apologies, relief at reaching the cool air, and then standing alone on the pavement as through the window, the whole table erupts into the best conversation of the night at the seats you just left. You cannot catch the recovery without enduring the fear that comes right before it. They are sold together in one bundle, and there is no side door. The fear is the price of admission to the rebound, and staying seated through it is the whole of the skill. Which is a clean, almost comforting rule. Stay seated, always. Except honesty won't quite let me leave it there, because sometimes staying seated isn't enough. Chapter 4. When patience is genuinely tested. I'd be selling you a fairy tale if I told you just hold on is a law of nature. Sometimes it isn't. Sometimes a market or a company takes not years but decades to come back, or never does at all. If we are going to hand our hardest decisions to patience, then patience had better be told the truth about its own limits, or it becomes just another form of hope with the lights off. Consider Japan.
On the last trading day of 1989, the Nikkei index closed at 38,915, a peak so high after so long a boom that it felt less like a number and more like a permanent fact about the world. Someone holding only Japanese stocks at that close did not see that level again until February of 2024. 34 years, nearly an entire working life spent waiting merely to break even. No amount of temperament rescues that. A person who simply held on and did nothing else spent their whole career underwater. American investors have their own hard chapter, closer to home. Across the 10 years from 2000 through 2009, the stretch people came to call the lost decade, a broad basket of U.S. stocks delivered roughly flat to negative total returns over 10 full years. An entire decade of saving, and the index had little to show for it. And single companies are more perilous still than any index. General Electric and Citigroup were both blue chips of the highest order, the kind of names a cautious person bought precisely because they seemed unsinkable. Both fell from their turn-of-the-century heights, and decades on, never climbed back to them at all. Loyalty to them was punished, not rewarded. So no, patience by itself is not the answer. Blind faith is only optimism you haven't stress-tested.
What protects a patient investor is design. 4 quiet pieces of it doing their work whether you're watching or not. The first is breadth. Own the whole world's markets, not one country's, so that no single nation's lost decades can trap your entire life savings. Japan's investors were undone in large part by holding only Japan. A globally spread saver felt that same stretch as one soft patch among many, not a 34-year sentence. The second is owning the market rather than a name. A broad, low-cost index fund is quietly ruthless in a way that protects you. It retires its fading members and lets its risers grow, without sentiment, without asking your permission. No single beloved company can sink you the way a lone stock can, which is the whole difference between the index that eventually recovered and the individual giants that never did. The third is a genuine time horizon. Money you truly won't touch for decades can outlast even a lost decade. And this is the part almost no one sits with. If you keep buying right through the decline, those falling prices are simply handing you cheaper shares. The steady buyers of the 2000s, the ones who kept their contributions running while everything looked bleak, were precisely the ones richly rewarded when the 2010s arrived and the market climbed.
Their patience was doing something the whole time, quietly accumulating cheaper shares. And the fourth, as you near the years you'll actually spend the money, is a cushion of bonds and cash, enough that you are never forced to sell your stocks at the very bottom just to pay for ordinary life. That danger has a name in the profession: sequence of returns risk, the quiet trap where a bad crash arrives right as you begin drawing money out, so you're selling assets low to fund your groceries and locking in the damage. Two people can earn the very same average return over their retirement and end up in completely different places, purely because of the order in which the good and bad years fell. The cash cushion is what disarms it. A couple of years of spending set aside, so a falling market becomes something you can wait out, rather than something you're forced to feed. Trade blind faith, then, for structured patience. Built this way, staying invested is protected by design rather than by nerve, which matters enormously, because nerve is exactly the thing about to fail you, right when you need it most. Chapter 5. Letting the habits decide. Think about when your resolve is actually weakest. It's not on the calm Sunday when you sketch your plans over coffee, feeling wise and far-sighted.
It's at 2 in the morning, 3 weeks into a falling market, with the pressure of loss aversion pressing flat against your chest, and the whole world seeming to agree that this time is different. Asking willpower to save you then is like asking a candle to hold a door shut in a gale. So we don't ask it to.
We make the decisions earlier, in daylight, while we're calm, and we let habits carry them out on the nights we're not. Think of a thermostat on the wall. You don't stand beside it all day arguing with the temperature, adjusting it every time you feel a draft. You set the rule once, and it holds the line while you sleep, while you fret, while you've forgotten it's even there. 3 habits work in exactly that way. Decided once, executed forever. The first, automate your contributions. Set a fixed amount to invest on a fixed day and let it run regardless of the mood and the headlines. This is what's called dollar-cost averaging, and its quiet gift is that a downturn stops being only a threat. It becomes the month your steady payment happens to buy you more shares than usual, precisely because they've gone on sale. The decision to keep buying through the fear was made weeks ago by a calmer version of you, and the machine simply honors it. You don't have to be brave on the day. You already were in advance. The second, on a peaceful day, write a single page.
Your mix of investments, the plain reasons you chose it, and one flat sentence in your own hand. Something like, I will not sell during a decline. Then, before you ever act in the heat of a falling market, you read it. You are leaving a note for your frightened future self, written by the person who thought this through clearly when nothing was burning. When the panic comes, your job is no longer to decide. Your job is only to obey the calmer, wiser version of you who already decided, and who, crucially, knew this exact night was coming. The third is the gentlest, and quietly the most powerful. Look less often. There's a finding from the economists Shlomo Benartzi and Richard Thaler with a fitting name, myopic loss aversion. The more frequently people check a volatile investment, the more individual losing moments their minds are forced to register, and the more timid and poorly timed their choices become over time. Remember that losses count double, so every extra glance at the app is another small serving of doubled pain, handed directly to the part of you most likely to panic. Check once a quarter instead of 10 times a day, and you're starving the fear of its fuel. The market's daily noise loses its grip when you stop offering it your ear. None of this asks you to be braver than you are.
It asks something gentler. To accept, honestly, that on the frightening days, you simply won't be at your best. Nobody is. And to arrange things now, in the quiet, so that on those days there is nothing left to decide. Courage you can't summon on demand. A standing instruction holds all by itself. So let's go back to where we began. The top you bought near, the bottom you sold at, and the recovery you watched arrive without you. I hope that memory sits a little lighter now than it did an hour ago. What happened to you was human wiring, doing precisely what it evolved to do, in the one arena on Earth where its instincts point backwards. You know the shape of it now. You know the cycle runs from hope to despair and back again, that losses shout at twice the volume of gains, that the market's best days keep close company with its worst, and that patience only truly holds when you've built it a structure to stand on, rather than asking it to stand on air. The people who do well at this over a lifetime are rarely the boldest or the cleverest in the room. They're the ones who quietly arranged their lives so that fear had less to grab. You can be one of them. It asks for no stronger stomach and no sharper mind. It can begin with something as small as a single automated payment and one honest sentence, written on a calm day, to a self you haven't met yet, the one who will be grateful, some frightening night years from now, that you thought of them. If this brought your shoulders down even a little, subscribing is the quiet way to let the next calm chapter find you when you need it. And tell me in the comments which idea stayed with you, the feelings that run backwards, the best days that keep bad company, or the habits that decide so you don't have to. I read them, and I genuinely like to know what landed. Until next time, take your time.